Just last week, the US market dropped again, and this time it was caused by the US slapping 25% tariffs on imports from Canada and Mexico, as well as 10% tariffs on imports from China, which uncoincidentally are the three biggest trading partners with the US. Prior to this, the stock market was going up strongly, like wee, and when the tariff news came out, the markets started to drop, like wee. As of making this video, the US market hasn't opened yet, but the S&P 500 futures had already dropped close to 1.9%, Nasdaq negative 2.55%, while both Nvidia and Tesla futures has dropped by over 5% for now. This is even worse for the crypto markets. So in this video, I'll be sharing what does all this mean, and are we now finally at the start of the next big market crash? But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. So back when tariffs were first introduced in the US from 1798 all the way to 1913, they actually accounted for 50% to 90% of the US federal income. But after that, the US effective tariff rate has been going down and down over the years. And today, custom duties only contribute to less than 2% to the government's revenue. That's because nowadays, tariffs are less preferred as they tend to be regressive as compared to income taxes, which are progressive, as well as many other reasons like competition, trade rerouting, and trade retaliation, which makes tariffs a lot less useful. So then, why does Trump want to bring back tariffs gao? According to the White House official statements, there are two reasons. One, the US wants to punish these countries for allowing illegal immigrants, fentanyl, and other drugs to come into the US. Two, the countries have trade deficits with the US. So Trump wants these countries to pay more, as he views deficits as a bad thing. Though, he also cited a few more reasons in the past, such as incentivizing companies to bring manufacturing back to the US, which he believes will help to create more jobs in the US and protect local companies. And he also wants to use tariffs to reduce the national deficit, which has been getting wider and wider over the past few years. Or, if possible, even consider using the new tariffs to replace the federal income tax altogether. While all these sound good in theory, many people are questioning the effectiveness of his tariff plans. For example, it was found that the tariffs Trump introduced back in 2018 not only did not increase manufacturing employment, the US saw a drop in overall employment, while cost to consumers rose by $625 per household. And while the US indeed has trade deficits against China, Mexico, and Canada, the truth is trade deficits are neither inherently good or bad. And if anything, it can be a sign of a strong economy. And what about the whole illegal immigrants and fentanyl problem? US government's reports show that unauthorized border crossings from Mexico have fallen over the past year, while seizures of fentanyl along the northern border are relatively low. Not just that, experts believe that even if the countries were to successfully clamp down on their part in the trade, it is unlikely that tariffs would help to curb the flow of illegal fentanyl, as the cartels who are truly responsible for the problem regularly change their methods. As for the claim about using tariffs to replace federal income tax, the math doesn't add up at all. That's because right now, even if Trump were to implement all his tariffs, which would bring the effective tariff rates to the highest rates that we have ever seen well before World War II, they will still only get $225 billion from tariffs as compared to the $2 trillion revenue from individual and corporate income taxes. So in short, not only tariffs are an ineffective strategy, countries that are hit by tariffs will also retaliate. For example, Canada has also imposed their own 25% tariff on the US, while both Mexico and China plan to impose their own tariffs as well. Studies found that if Trump fully implements his tariffs, it would cost a typical household higher prices, more than 500,000 job losses, as well as reduce the country's GDP by at least 0.8%, while not even accounting for retaliations from other countries. Quick pause. If you are looking for the cheapest broker to start your investing journey, check out Interactive Brokers. It has the lowest fees for stocks, ETFs, options, and more. Not just that, Interactive Brokers lets you easily research stocks. Like, you want to check out companies' financials? Here it is. You want to check out analyst ratings? Here's a bunch of them. It even has free technical insights which tells you where the stock might possibly go next. So sign up to Interactive Brokers today, and let's get back to the video. With these new tariffs, prices of mineral fuels and oils would go up. Since the US imports a huge part of its oil from Canada, car prices would go up as well, as a large part of US cars are imported from Mexico and Canada. Prices of wood, iron and steel would go up as well, which will in turn raise the cost of construction and renovation, alongside with many other products such as phones, computers and motor vehicle parts. Though, with that being said, many analysts believe that the likelihood of Trump implementing all his tariffs are low. That's because in 2018-2019, Trump was threatening tariffs on its major trading partners, and if all of them were implemented, it would bring the average tariff rate from 1.4% to well over 11%. But by 2020, it was only raised to 2.8%. Not just that, Trump also forged a Phase 1 trade deal with China, while also successfully renegotiating the United States-Mexico-Canada Agreement, a free trade agreement to mutually benefit the three countries. So if history is any indication, these tariffs would serve more as a negotiation tool rather than trying to outright punish the other countries. Though, interestingly, the International Monetary Fund also did a study and found that even with all the tariffs and full-scale retaliation, it would still result in a very small 0.4% hit to the US growth and a 0.1% reduction to the global GDP. That's because trade isn't a huge component to the GDP. As such, it won't tip any of the major economies into a recession in 2025. Also, it's worth noting that back then, even though the prices of some goods like washing machines went up by quite a bit, the US inflation rates in 2018 and 2019 remained relatively stable at around the 2% range. While at the same time, global trade volume didn't drop by much during that period, as companies can just reroute their goods through intermediaries to avoid getting piaked by tariffs. Which brings us to the question, what will happen to the stock markets in the near future? Will it keep boom and crash 50% from here? For this, there are two historical examples that we can learn from. The first one was in 1929, when the US introduced a tariff bill that caused the Dow Jones to crash by 89% over the course of several years and marked the start of the Great Recession, where the US GDP dropped over several years and the country experienced high rates of unemployment and poverty. However, as opposed to what many people would think, this tariff bill did not cause the Great Recession, but rather it just worsened the conditions that were present during that time, such as overinflated shares, growing bank loans, agricultural overproduction, panic selling, and higher interest rates, many of which aren't present today. For example, right now, the US economy has been growing strong, and while interest rates are elevated, it is still a lot lower as compared to back then. And while it's true that the S&P 500 is a little overvalued, it is actually supported by strong company earnings, where in the latest quarter, 77% of S&P 500 companies have reported positive EPS surprise, while having the highest year-over-year growth rate since Q4 2021. In that case, perhaps a more relatable tariff scenario would be in 2018 and 2019. When Trump started his first trade war. During that period, the US economy was actually growing strong just like now. Unemployment rates were also low, though the federal funds rate as well as the inflation rates were a little lower than the current levels. Despite the good conditions, both the all-world index as well as the US market fell close to 18% over the course of 1 year. However, this wasn't due to any real negative reasons. That's because if you compare the S&P 500 change in forward 12-month EPS versus change in price during that period, you will realize that company earnings didn't really drop. Instead, the crash was more due to the forward-looking nature of markets, where investors were panic selling as there were a lot of uncertainties during that period. Then in 2019, both the US and the global markets rebounded spectacularly, with them rising more than 30% from this bottom and would have continued to go up, but you know, the pandemic happened in 2020. So will history repeat itself and the market crash by close to 18% before coming back up? I don't know. But according to Tom Lee, aka the Perma Bull, he expects the markets to overreact, just like right now, which represents a good buying opportunity. And if anything, he and many other analysts are still bullish for 2025 despite all of Trump's plans. That's because he sees multiple tailwinds in 2025, such as there's a lot of cash sitting on the sidelines, Trump's pro-business policies such as deregulations and tax cuts, as well as inflation are now under control, which means, in short, there's nothing much to be worried about lah, especially if you are buying good quality stocks. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.